p.m. Eastern. Stocks are currently trading higher, but set for a third straight losing month. This comes after a recent rise in Treasury yields. Earlier this month, the 10-year yield reached 5% for the first time in 16 years. Markets responding to the most restrictive rates in more than 2 decades and geopolitical tensions. We'll break down some of the best and worst performers of the month later in the show.
And crypto in court. Sam Bankman-Fried's defense team resting its case earlier after 3 days of testimony from the FTX founder. Bankman-Fried testified that he didn't know his hedge fund, Alameda Research, spent billions of dollars of FTX's customer funds to prop itself up, and that he wasn't in on the day-to-day operations at Alameda. We're going to hear closing arguments from both sides tomorrow, and in the 4 p.m. hour, we're going to break down everything you need to know as the court wraps up its 4-week trial.
And real estate reality, the housing market showing no signs of opening up. Tight inventories driving prices higher for a 7th month in a row. That's according to the Case-Shiller National Home Price Index. 13 of the 20 major metro markets reporting price increases in August from a month prior. We're going to break down the impact to home buyers. Let's get you up to speed on the market action. In the meantime here, we've got all 3 major averages in the green. Modest rally here with the Nasdaq showing gains of about 0.5%. The S&P up about 2/3 and the Dow up 136 points. That's about 0.4%. Real estate actually is the best performing group today, followed by the financials and consumer discretionary also performing strongly.
The Fed kicking off its 2-day meeting earlier, which will culminate in a decision on interest rates tomorrow. Investors largely pricing in no rate hike in November, but there is still a shot we see one more hike in this cycle, as Fed Chair Jerome Powell has reiterated inflation is still running too hot. The labor market continues to show strength, and consumers, they keep spending, begging the question whether the full effects of higher rates have yet to be felt. That can be said for many non-financial companies who haven't been emphasizing rates in earnings calls. So, Julie, you've been digging through the earnings calls. That is a trend you're not seeing, I guess.
Yeah, I have a new hobby.
Yes.
It's not a super fun one, but it's an interesting one. I have been going through some of the key conference calls, word searching rates, interest rates, et cetera. And what's been surprising, we talked a little bit about this last Friday, is how few companies are calling out specifically the effect of higher rates. They might be listing it as one of the macroeconomic pressures. What's more, analysts aren't really asking about the effect of higher rates. One of the few sort of very specific commentaries I found was from Caterpillar's call this morning. We're going to talk a little bit more about Caterpillar's numbers in a bit, but specifically they talk about the effect in their financing business, where they're sort of competing with banks actually on financing for their equipment. But otherwise, and I know our Brian Sozzi talked to some CEOs also and wrote about it earlier in the week in his morning brief. There's a lot of companies talking about forward planning, maybe that it's affecting some of their investment decisions. But considering how much rates have moved, there's sort of remarkably little discussion about the concrete impact on earnings.
Yeah, and you do wonder whether some of that is just lag effects maybe taken, because obviously the Fed, not just the Fed, I mean, policymakers have been raising rates. The mission here, let's cool inflation by restraining growth. But we know that comes with lags, meaning the time between a rate hike and the impact of that hike on the real economy, which, by the way, of course, it makes it tough for policymakers. They don't always know the decision they're making is it the right one, whether they're hiking too much or too little.
Yeah, I think this is a really, you make a good point, which is the lagged and variable effects of interest rate increases. We've seen some areas where it has had an effect on the housing market, for example. But when it comes through the read-through for the consumer, which might affect some of the companies we've been hearing from, McDonald's, for example, they've talked about the effect, the depressive effect on some consumers, but overall consumer spending has still held up, and maybe that speaks to the lag that we might see.
You also wonder whether is it because, and we have a great guest coming right up who can speak to this, is it because also did consumers and businesses, did they enter this period, this new period of higher borrowing costs with solid cash levels? Maybe that's helping as well.
That's something I've been hearing from some analysts.
All right, let's ask a very smart person about this.
Let's do
it. The Fed's decision on interest rates coming tomorrow, and it's very likely we're going to see no change in rates. Powell and company consistently pushing the higher for longer stance. But what does longer really mean? For more on this, we turn to Vincent Reinhart, Dreyfus and Mellon chief economist. Vincent, thank you so much for joining us. And maybe just weigh in there, Vincent. I don't know if you heard us. Julie and I were talking about these lag effects and the debate there, Vincent, short, long. How do you see this dynamic?
I see it as the essential talking point, the essential discussion point in the FOMC meeting that's going on today, right now, and into tomorrow. How much of the tightening they've already done is still in the pipeline? Can they expect more constriction from financial conditions tightening, i.e., long-term treasury yields going up, equity markets selling off, and how much on bank balance sheets? And the committee basically divides on that issue. There are those who counsel patience, and there are others who say you've mostly seen everything you're going to get. If you need to restrain the economy more, you got to do more. Right now, it's a pretty close call. Not for tomorrow. They're done. I mean, they're not going to do anything tomorrow because they hate surprising markets. The interesting thing about tomorrow is how does Jay Powell talk about lags in this press conference to lean into what they'll do in the December meeting?
Vince, it's Julie here. Obviously, the Fed is very macro focused, but I am curious how much they might be taking into account some of the corporate commentary we're getting. As we were just talking about, we're not hearing a lot of concern being expressed. But on the flip side, within some of the regional Fed reports, within the Beige Book, within the regional manufacturing reports, there is more negative commentary. So how does the Fed weigh all of that?
So, Julie, if it makes you feel any better, I actually read the Beige Book, which makes your earnings reports look, like War and Peace. And the thing to remember is it's not a macroeconomist at the top of the Fed right now. Jay Powell's a lawyer by training who got into business acquisition and working at Carlyle. So he's much more a banking guy, much more a micro picture than the big macro stories that Fed officials mostly look at. And so the interesting thing among many for today and tomorrow is what do they hear about banks? Because they're going to get a senior survey, which is the only take you have on banks' willingness to make loans and their assessment of demand and what they're doing in terms and standards. If you're thinking there's policy constriction in the pipeline, you're going to want to look in the senior loan officer survey. You want to look at the micro data. You want to look under the macro hood.
And Vincent, I'm interested that, the mantra higher for longer, break that down for us a little bit, Vincent. What does that really mean? How much longer do you believe? And the longer they keep rates high, is there increasing risk, do you think, of a policy mistake, that something breaks in the system?
Yeah, the answer to the question, is there a risk for a policy mistake, is always yes. And Federal Reserve officials live with uncertainty. The policy is high for long, and it's essentially a low information strategy. Nobody knows what the neutral federal funds rate is. Nobody knows, therefore, what the point is between where policy is accommodative and where policy is restrictive. So what do? You put the funds rate in a place where you're confident it's restrictive, and you keep it there until you see the consequences. You see inflation going back to goal. That doesn't require a lot of understanding about the neutral rate, only that where you are is above the neutral rate. It's also resilient to rounding. A quarter point here doesn't mean that much. Why? Because you always can adjust for what the level of the funds rate is by how long you keep it high. If you put it too high, then you just won't keep it there very long. If it's not high enough relative to the neutral rate, you'll just have to keep it there longer. That's the low information strategy suited to Jay Powell. He's a big picture guy. He's not trying to fine tune. As he keeps saying, we'll know it in its works. Just keep policy restrictive until you see the consequences. How do they have to go another quarter point? Maybe. That probably depends on the incoming data. Powell will probably lean a little bit toward that for the December meeting. How long will they keep it there? As long as it takes. That's probably well past next summer. You're not looking at a rate cut until the fall of 2024, which means markets got it wrong right now. Futures markets have too soon a pivot by the Federal Reserve. They don't turn the boat that quick.
And Vince, I haven't heard the phrase soft landing in a little bit. We were uttering it like every day for a while there. But what happens if the Fed doesn't see the signs, right? That things are cooling off, backing off a little bit?
Answer to the question is yes, a policy mistake's possible. Remember, to your point, this is a Fed that tightened in March during a bank run, that kept tightening policy, even though for most of the time its staff had forecast a recession. They're going to have to be convinced that the outcome is bad in order to pivot. So more likely they're going to lean into economic weaknesses than not, as long as inflation is not assuredly at their goal. So yes, the risks are probably to the downside. They're more likely to over tighten than under tighten.
Vincent Reinhart, thank you so much for joining us today, Vincent. We always appreciate it.
Thanks for having me.
Let's take a look at some trending tickers right now. NVIDIA stock down about 0.8%. It's pushing its market value below, though, that $1 trillion mark. It's after the Wall Street Journal reported new U.S. chip export rules may force the company to cancel up to $5 billion in advance orders. So these export rules to China bringing up some questions about NVIDIA's opportunity there. The journal specifically saying the company might have to cancel billions of dollars worth of advanced chip sales to China. You know, the company has $5 billion in orders to China that are vulnerable to these latest U.S. rules. I think it's an NVIDIA story, but I think it's also just a broader story, Julie. I mean, there are a lot of American companies. They look to China. They see it as a real growth opportunity. But given these geopolitical tensions between Washington and Beijing that are running hot and seem to be just getting hotter, I think investors are right to question what does the opportunity look like there. Some people think it's going to be perhaps a lot more narrow and lower margin than maybe we once thought.
Well, and, you know, all of these rules are also pushing a lot of homegrown development in China as well, as the race to develop these advanced AI chips is continuing. If NVIDIA isn't going to ship them there, will there be a company, and there are companies there, of course, that are working on this. For NVIDIA specifically, I was trying to sort of back of the envelope, what does this mean for it? According to this journal report, orders from Chinese companies for NVIDIA in 2024 were around $5 billion. That's what the journal's report says, citing people inside the company. If you look at its revenue over the past couple of years, around $26 billion. So we're talking about, you know, not a huge amount of their sales, but not an insignificant amount of their sales either. So it's just something to think about here. And to your point, yes, of course, other companies have to factor that in. This particular rule really does seem to be very specifically not aimed at NVIDIA, but that's who it's going to be affecting. Exactly. Yep. So we'll see if it does go beyond that. And of course, meantime, we're waiting for AMD after the close of trading today. The chip results that we've gotten as of late have been sort of mixed, right? You know, you had an Intel on the plus side, you know, on semiconductor on the downside. So it's kind of dependent on what sector within semis they were, but obviously AMD's comments on China are also going to be very interesting.
Critical, absolutely.
Yeah, definitely.
And AI, we should mention.
Yes, definitely. Let's talk about Caterpillar as well. It's the worst performer on the Dow today after disappointing sales guidance that hit the stock. There was a $2 billion decline in its order backlog compared to a year ago. That does imply slowing demand. Now, Caterpillar is a really interesting situation because the company has said it's normalization. They're talking about supply chain conditions that are sort of balancing out now. So the company is sort of trying to talk down the alarm that has come as a result of this backlog going down more than anticipated. But obviously, it's not working.
Yeah, no, so it is a backlog. The order backlog story is the metric everybody's focused on.
Yeah.
That shrank in Q3, year-on-year decline of about $2 billion. So that just keeps up worries. You get worries about demand, about the economy, about the quarters ahead. And you think of Caterpillar as a kind of bellwether because that equipment's used in energy and mining and construction. It touches a lot of important end markets. That's why we pay so much attention to it.
I mean, it's interesting, though. The company says that the reason that its backlog has gone down is because customers have grown more confident they can get their things quickly. In other words, they were ordering in advance before because they didn't know when, like we all had this experience during the pandemic. You order a couch expecting to get it a year later. And apparently that was happening in the equipment market as well. Now, you're getting your couch, you're getting your equipment in short order, so you don't place the orders in as far in advance. At least, again, that is what Caterpillar is saying. It is interesting that narrative is not proving convincing.
No, it's not. And now we're firmly in red year to date. I'm looking at Caterpillar down about 5% so far.
Yeah, and down on the year.
All right, our last one here. Sarepta Therapeutics plunging nearly 50% after a trial of its gene therapy for Duchenne muscular dystrophy showed no statistically significant improvement over a placebo. So this one is getting obviously hit very hard. I guess from the reports I'm reading, Julie, there was improvement in patients, but the key here, it just didn't hit the trial's target. That seems to be the issue.
Yeah, and it looks like that they still might be able to prescribe it to young children, but over age 7 because of this study, they might not be able to expand the indication for children of that age. Now, Sarepta, this particular medication, like many that the pharmaceutical industry is banking on right now, is a so-called orphan medication, right? It's not used for many uses and it's not used for many patients, but it is very, very expensive. In this case, $3.2 million. It's a one-time treatment. The company has said that the price will be about 20% lower after discounts, but still, it's obviously a very high price drug here for this Sarepta treatment.
Yeah, I'm watching financial analysts who cover the name too. They are making moves today. You can see Cantor, they downgrade the stock to neutral. Price target goes to 40, saying there are a lot of uncertainties ahead. So they move to the sidelines. And Oppenheimer does the same thing, downgrades to perform. So a hold, effectively pending, they say, greater clarity on FDA feedback. So the street's making decisions too.
Yeah, and there's a bit of a ripple effect as well. Roche, which is developing this drug along with Sarepta, is down today. And there's a company called Catalent that is a supplier for Sarepta that is down, although Baird said today that the sell-off was overdone and they like Catalent on this. But those shares have been down sharply as well. All right, we're just getting started here on Yahoo Finance Live. Coming up, housing hurdles, home prices rising for the 7th consecutive month in August. We'll break down what it means for home buyers. And Sam Bankman-Fried on trial. The defense rests after 3 days of testimony from SBF. We'll talk about the latest developments and preview closing arguments. And the rich rule. Americans who earn the most money typically account for the largest share of consumption, but the numbers have gotten more dramatic post-pandemic. We will explain and talk about the implications after the break.
2023 rocked the markets.
NVIDIA, the stock has been on a tear.
Silicon Valley Bank's collapse is the second largest bank failure in the U.S.
Inflation,
mortgage rates,
the diabetes drug, Ozempic.
Now it's time to make bold decisions. Yahoo Finance Invest, the marquee event for investors seeking big ideas and bold decisions. Guided by the newsroom you trust. Don't miss it November 7th, exclusively on Yahoo Finance.
Consumer spending continues to surprise to the upside this year, even as confidence falls. Though when looking under the surface, the resilient consumer lies within a specific group of Americans, the wealthy. At least that is according to some research that was out recently from Morgan Stanley, the economics team there, where they looked at and they said the trend since about 2004 is that 39% of consumer spending in the U.S. accounts for the top 20% of earners. Now they said that number has gone to 45%. So even though there's been a slowdown in lower income spending and even creeping into middle income spending, the rich are still spending, and that's one of the reasons that we are still seeing GDP hold up.
Yeah, I like this story because we have this habit. We often just talk about the consumer.
Right.
But of course, there's many consumers, and there are storm clouds for the consumer. We talk about them a lot here. It's rising energy prices and higher borrowing costs, the resumption of student loan payments. But that obviously hits the lower income consumer differently than the affluent neighbors, right? And there are signs that the low income consumers under some pressure. So you're relying on that affluent consumer even more to carry the baton. And what matters to that group, according to Morgan Stanley, is housing wealth, right?
Yes.
And home prices, they note, are up 40% since pre-COVID levels. They also note corporate equities are up about 30%. That's all helping. Question is, going forward, does it look as rosy?
Right, and they say they do expect things to start to deteriorate. One of the other things that has characterized past pullbacks in wealthy people's spending has been a drop in white-collar, so-called white-collar jobs, right? Which also happened around the financial crisis, in addition to a double whammy of home prices falling and stock prices falling. So that's one of the things that exacerbated the economic environment during that period of time. Now, Morgan Stanley doesn't seem that pessimistic. They say things will start to sort of deteriorate, but they're not looking for a sharp fall because they're looking for sort of stagnant home prices next year, but not a fall off a cliff. And doesn't sound like they're looking for a big drop in stock prices.
I thought it was interesting, though, the way they did detect, though, some signs that maybe that pressure is moving a bit up the ladder. Like in the note, how they talked about there are signs the middle income consumer is pulling back because they're checking with their teams that cover things like fine dining and luxury shopping.
Right.
So the pressure may be moving a bit up the socioeconomic ladder.
Yeah, we've seen some luxury companies also that have talked about a little bit of wavering. So we'll have to see how it all plays out. But let's talk more about the consumer and how this feeds through to the economy, to stocks, to the Fed. One of the other signs we're watching, the Conference Board's consumer confidence reading saw declines for a third consecutive month. Our next guest says the consumer is slowing, and you should consider investing in high-quality companies in this environment. As a result, here to discuss is Gargi Chaudhry, who is head of iShares Investment Strategy Americas at BlackRock. Gargi, it's great to see you. Thanks so much for being here with us. I want to talk and dig it into a little bit more this notion of the consumer and how it is sort of supporting the economic environment. And I'm wondering how closely you're watching that theme and if you're starting to get concerned.
Hi, Julie. It's great to be here. Thank you for having me. Great new space that you guys have back there. So absolutely, to your question, we think that how the consumer behaves over the next couple of quarters will be extremely important for anyone that's watching the markets for a couple of reasons. Obviously, we saw in the Q3 GDP that the consumption strength was a big driver of that 4.9% GDP. So if there's any slowdown on the path of the consumer, that is obviously going to feed into growth. But the other thing that I think has been really interesting is watching the monthly consumption, spending, and income data. And one thing that I've been paying particular attention to is the drawdown of the savings rate, right? So yes, the consumer is spending, but there has been a depletion of the savings rate down from sort of that 7% pre-pandemic level to about a little higher than 3.5% now. So the consumer feels confident to dip into savings, but how much further can we expect that confidence to last, especially when the restrictive policy rates that we are already at begins to bite? And at the same time, we have some other headwinds, such as, of course, as you guys mentioned, the resumption of the student loan payments, financial conditions tightening, and perhaps, some kind of government shutdown in November.
And Gargi, I'm interested, so these trends, these themes that you're seeing in the consumer, are you seeing them show up during this earnings season, which continues? We've got AMD after the bell. We've got, of course, the big one, Apple, on Thursday. Are you seeing these trends you're talking about highlighted when you hear CEOs and CFOs on the conference calls? What are you What do you make so far of this earnings cycle?
Sure thing, Josh. So definitely on the earnings cycle so far, I think from the expectations that we had coming in, we've sort of been meeting them. But what's been interesting to us is looking at the data. When companies have missed, they've been punished a lot worse than in previous couple of quarters. When I'm looking specifically at companies that are talking about the shape of the consumer and the health of the consumer, there is some concern that we're getting just around the lagged effect. So it's not necessarily about rates now. It's not necessarily about inflation anymore. We're not hearing that as much, but it's really about concerns around the lagged effects of higher rates and what that might do, which is exactly why, to your point earlier, I think watching how the consumer behaves is going to be really important for forecasting growth, whether or not we want to call it a soft landing, no landing, etc. But I think that's going to be a big driver of growth and actually how we make investment decisions, which is why we favor quality still.
It's so hard to time all of this, isn't it, Gargi? Because we thought, so many predictions thought that things would slow down already. But I know you're looking at quality, which I guess the thinking is it can work even in advance of all of this rolling over, right? What does quality look like?
Yes, what does quality mean? That's a question we get asked a lot. And here we're looking at companies that have margin resiliency, that have free cash flow, that have strength of balance sheet, that have low debts, low leverage. And I think that's particularly important in periods where interest rates stay higher for longer, which is exactly the period that we're in now. So focusing on quality, staying invested. Look, none of us had probably expected the year to have turned out the way it has, but I think staying invested and staying towards the higher quality parts of the market in a sector neutral fashion, we think makes a lot of sense. And I'd say the same for the bond markets. We're obviously looking at the QUAL ticker here, but I'd say up in quality also applies for the bond markets, where especially going into the year end, as investors are looking to perhaps tax loss harvest, take some opportunities where they've had some price negative returns in their bond portfolios and their core bond portfolios, moving to quality parts of the fixed income ETF market, such as the 3 to 7 year Treasury bond ETF, which is IEI, which we think, again, makes a lot of sense when we're looking at a Fed that's more or less done in their hiking cycle.
And Gargi, you mentioned how we're heading into year end here. I was wondering if you're in that year end rally camp, Gargi, because I saw Morgan Stanley's Michael Wilson. He is not expecting that. He says chances of fourth quarter rally have fallen considerably, Gargi. He mentioned narrowing breadth. He mentioned falling earnings revisions, talked about fading consumer and business confidence. Where are you on that?
Sure. So obviously the seasonals, as your listeners know, are very strong for November and December. I think a lot of what the market does for the next 2 or 3 months will depend on what interest rates do. If we continue to see rising real rates, if we continue to see a bear steepening in the yield curve, I think it's going to be very hard for the market to continue to do as well as it has done the last few days. But I think if this is near the peak of rates, I think we can possibly see a market that goes up a little bit from here, not massive moves, but sort of getting back to the 4,200 or a little bit higher level, which the market has hovered around for some time. I think a lot of that hinges on the rate dynamic from here on. More bear steepening, I don't think bodes well for equity markets. But in either case, I think investors should be thinking about a little bit longer term than just the next couple of months. And I think that with growth looking solid, slower from here, but solid, I think we're going to do well remaining in the higher quality parts of the equity market as well as the fixed income market for the next 6 to 12 months.
Looking beyond a couple of months. Revolutionary, right, Gargi? Thanks so much for giving us some perspective here. Gargi Chaudhry, thank you so much. Appreciate it.
Thanks.
The housing market showing no signs of opening up. Tight inventories driving prices higher again in August to a new record high. It's according to Case-Shiller Home Price Index. Joining us now is Craig Lazzara. He's S&P Dow Jones Indices Managing Director. So first off, Craig, just give us the report, Craig. What are the highlights we need to know?
Josh, I think there are two main things to say. One is that it was a strong report, as you alluded. On a month-over-month basis, the national composite was up about 0.4%, which is quite a strong report. And this is the 7th consecutive month in which prices have increased. The other thing that's important to note is that the report is the strength in the housing market is fairly broad. We track 20 cities in addition to the national composites. On a seasonally adjusted basis, prices were up in 19 of the 20, and the one that missed was just by a whisker. So it was a strong market in terms of breadth. It's a strong market in terms of level.
And when you, it's Julie here, Craig, when you look at the different cities, or the different regions, are they equally weighted? How do you all think about that in the composition of this index?
Well, they're weighted by the number of transactions that take place. But the interesting thing about the regions is to see how there's been a shift in the relative strength. I mean, if we go back 2 or 3 years, Phoenix, Arizona was the strongest city for a run of about 3 years in a row. And Phoenix is now actually trending downward. The strongest city, the strongest metro area, I should say, for the last 4 months has been Chicago, followed by New York. So it's been I referred to it a few months ago as the revenge of the Rust Belt, and that's really been what we've been noticing lately as prices in the Midwest and Northeast have recovered more than those in the West and South.
And Craig, now here's the point I asked you to bring out your crystal ball. So prices remaining elevated. What do you see ahead, Craig?
Well, there are two kind of countervailing things, Josh, both of which come from the presence of rising interest rates. The obvious thing to say is that rising mortgage rates make it harder to afford a given house with a given level of financing. So you would expect rising rates to suppress demand, and you would therefore expect that the rates that have risen so far this year would have led to weakness in the market. In fact, we've seen the opposite. I think the explanation for that is because rates were so low for so long, people were able either to buy with very low mortgage rates or to refinance into very low rates. And so if someone wants to move now, they're looking at increased financing costs, and that has the effect of reducing the supply of available houses. And net, it appears that, at least for the time being, the rise in mortgage rates has probably diminished supply more than it's diminished demand.
Right. It's a very tricky situation for a lot of folks right now, Craig. Everybody wants to know when it's going to change, right? Which, if we all knew the answer to that question, well, we'd be doing pretty well. But I'm just wondering, historically, when you look at your other indices, sort of looking at them against this one, is there anything that can help us as a leading indicator to help try to figure out when this might start to roll over?
Not really, and we've tried to do this historically to model S&P Case-Shiller to say, well, what other indices would match up, and it's very difficult to do, which is a way of saying there really is unique information that's being incorporated into housing prices. But speaking more broadly, I would say that if there were a true signs of economic weakness, and I don't see many of them, I'm not an economist, but I don't see many of those. I mean, employment is doing well, earnings are coming in okay, but certainly either of us could think of any number of things that might be a shock to the economy and would push the economy into recession. If that were to happen, I would be surprised if housing prices held up. And if it is true that the increase in rates has had the effect of suppressing supply more than demand, it's at least arguable that if rates level out and mortgage rates level out and begin to decline, maybe that would have the effect of freeing up some supply, and then the rate of housing price increases might moderate somewhat.
Yeah, although we'll see what higher for longer, what effect that has on mortgage rates specifically. Craig Lazara, thank you so much for your time. Appreciate it.
Thank you.
Coming up, data protection company Commvault reporting earnings this morning, beating on the top and bottom line. We'll talk about what it means for investors with Commvault's president and CEO next. The White House is convening leaders from around the world today to confront what it considers a pressing international issue, cybersecurity. President Biden's International Counter-Ransomware Summit plans to create a wave of new efforts to fight cyber attacks, which have risen by 45% in the last year. This coming as Commvault, a data protection company, reported better than expected results as it looks to AI to help fight cyber threats. And the president and CEO of the company, Sanjay Mirchandani, joins us now. Sanjay, thank you so much for being here. I think the White House convening this group today, illustrates the difficulty and the urgency of trying to fight some of these threats. What are you hearing from your clients right now as you try to sort of catch these threats before they can infiltrate these companies?
Sure. So firstly, thank you for having me. Data has never been more valuable to companies and also more vulnerable. And the bad actors want the data. And so what we do is really help customers protect their data and give their business the resilience it needs in the event of an attack. So we're seeing a lot of conversations. I can go meet a customer without talking about ransomware strategies at the board level, at the CEO level, because this is becoming, it can be catastrophic for businesses.
And Sanjay, it's a time of a lot of uncertainty right now, economic uncertainty, geopolitical uncertainty. What are you seeing in terms of customer spending patterns?
We're seeing customers really looking at cyber resilience as a key area, because at the end of the day, you know how to manage a supply chain, you know how to manage things that you've dealt with, but a lot of companies don't know how to deal with cyber threats. And we just did a survey with IDC where it came through over 500 customers that about 30+% of CEOs are actively involved in being ready for a cyber attack. And over 60% of the respondents actually felt that they would get breached in some way in the next 12 months. So this is real. The bad actors have tools like AI and other tools to do the things they do. So we have to always stay one step ahead with our customers. Our customers are spending on areas like cyber resilience.
What's the most important thing in detecting these threats before they get in, as you see it, in terms of these companies sort of being attacked? What's the most important thing your clients need to know, or companies generally need to know?
So there's several frameworks and life cycles as to how to think about this, from identifying the threat to getting ready for the threat to be able to recover from the threat and everything in between. And, so the most important thing is really, but today, it's not so much about just defending or just recovering. It's about resilience, making sure your business can come back to life in the event that something does happen. And my advice to boards, to CEOs, to CIOs is assume that you're going to get breached. And if you do get breached, how resilient is your business and how well can you recover? And that's our focus, really giving businesses the continuity to be able to come back and recover in a safe and predictable way.
And Sanjay, there's been, as you know, just a boom of interest in AI. How are you all leveraging that technology, and how's it going to benefit customers?
So we've used AI for many years in our technology, but next week we've got a big event, a big release, where in the platform that we're bringing out around cyber resilience, AI is going to be infused right across the platform, whether it be operational excellence and automation, whether it's really about recovery capabilities, managing your data in large scale. AI is going to be infused and a core part of how we deliver our capabilities starting next week.
And Sanjay, finally, you got a lot of questions on the call about your forecast and about the sort of mix of customers, subscription versus non-subscription going forward. Can you just briefly kind of walk us through that and what it signifies about consumer demand, or customer demand, I should say, going forward?
Well, first of all, demand is strong because our numbers, for the second quarter and for the first half, where we've exceeded most of our KPIs, if not all, and we actually guided up on both ARR, which is the forward-looking metric, annual recurring revenue for our business, as well as overall revenue. Customers, with higher interest rates, the commercials and how customers look at acquiring software can vary, whether it's a perpetual one-time purchase or a subscription on an annualized basis. But overall, given the importance of what we do and the hard problems we solve for our customers, we actually guided up for the year.
All right, Sanjay, thank you so much. Sanjay Mirchandani of Commvault. Appreciate it. Thank you.
Thank you.
Coming up, more tech on deck. Apple reporting earnings after the bell on Thursday. We'll preview the numbers and tell you what to expect from the report next. Stocks are on track for their third straight monthly decline. Jared Blickery is on the floor of the New York Stock Exchange right behind us with a look at some of the biggest moves of the month. Jared, what do you got?
Yes, it was of the majors here. We have the Nasdaq, which was the worst off. It's the small caps that really took the cake. And I'm going to go to the Wi-Fi Interactive and plot this real quick. Then we'll get into some heat maps and really see where the damage was done and where we saw some gains in the month. Here's a Russell 2000 ETF. That's down almost 7%. And just take a look at the 3-year chart, just knocking on the door of these lows that we've had all the way back to last year. A little bit concerning. We were supposed to be positive this month, according to history, but the bond market got in the way, I should say. Here's what's happening today in sector action, but let me just dial this into the monthly time frame over 22 days. Utilities in the lead here, up 1%. Tech is a big fat zero. That's break even. But you take a look at the downside. We got energy down almost 6%. Consumer discretionary, that's retail 5.5%. Materials, healthcare, and industrials rounding out those down 3% or more. And just taking a look at our leaders here, only 2 things in the green. Crypto, we have a Bitcoin ETF up here. That's up 27%. Huge rally late in the month. And then defense. This is a defense ETF and aerospace too, I should say. What's really taking it on the chin here is cannabis. Cannabis down 21%, solar down 19%, ARC is down 11.7%. And let's just go to the disruption trade here. Looking pretty nasty for the month. A lot of these guys on the bottom row down from 14 to 24%, including Roku down 15%. China really not looking that much better, although we got some green names in there. Just taking a look inside the semiconductors, tech had kind of a mixed month. I was just saying tech was not as bad as it could have been this month, at least as far as its mega cap cousins go in consumer discretionary and communication services, a little bit of green there, and a little bit more in software. Let's move on to our next page where we have regional banks. Those took a pretty big hit. We haven't seen something like this since March. So looking ahead toward the month of November, just want to say this is a real quick chart on seasonality. We tend to rally in the month of November, but not until the end. Seasonality failed us in October. We'll have to see if it takes us to the promised land in November and beyond.
Jared Blickery, all the action and insight from the floor of the NYSE. Thank you, Jared. Apple unveiling new products at its Scary Fast event, including the lineup of its M3 chips. But that's not all for Apple this week, of course. Tech giant representing about 7% of the S&P 500 is also releasing its financial results this week. And this comes after a mixed reaction on Wall Street from big tech earnings thus far. Here to discuss this is Ben Beharin of Creative Strategies, CEO and Principal Analyst. Ben, it is great to see you. Let me start off with the news here. So Apple introducing the new M3 chip family. These are the processors that are going to be powering the new MacBook Pro laptops and the new iMac. And so, Ben, my first question is that enough, Ben? Do you think that's going to be able to drive meaningful sales here?
Yeah, I think one of the most important takeaways is that we've had a really soft PC market, obviously coming off a tough comparison from sort of the COVID pull forward that we saw, and that was clearly reflected in 2024 sales for Apple. So I think we're starting to see life of that recovery as shown by Intel's earnings, that we're seeing now more momentum carry into 2024 for PC category sales, which Mac fall into. And so I think they did a lot to make the Mac more attractive and more competitive, as they've been typically on a good run rate to take share in the high-end portion of the PC laptop market.
Hey, Ben, it's Julie here. Apple did something unusual in the rollout of this event in terms of its timing. It was in the evening, last evening, I guess sort of a Halloween theme on the day before Halloween. Any takeaways from that? Were they trying to speak to a different audience? Were they just trying to be cute? What do you think?
Yeah, I think obviously the evening event fit the theme, but I also think there's Asian markets, China and Japan, that time frame catered to as well. Both of those, honestly, have been some pockets of growth relative to the Mac, not gigantic, but at least certain relevant audiences where they're continuing to see consumer interest there. So I think some of those time zone changes for a Chinese and a Japanese market was helpful, and probably one of the reasons why they made it later in the evening, which is more earlier in the day in those time frames.
And Ben, I want to switch gears here, talk about earnings. Apple reporting at the close on Thursday. And as always, Ben, heading into this report, we get all kinds of reports about how the new iPhones are doing. We have bullish reports. I've seen bearish reports. I'm just interested to kind of get your take. What do you think demand is like, really, for that new iPhone 15 family?
Yeah, it sounds like demand is still constrained. If you look at a lot of the research coming out around wait times, there still are significant lead times. Some of those have been easing on different weeks, but it certainly shows that there's still some sustained demand, at least for now. Again, the question has always been smartphone recovery and the strength of that market. We've been waiting to see signs that China is starting to come on board, and I think we're starting to see that market recover. And obviously, this is a particularly strong upgrade cycle for people who want the premium of the high-end devices. So that'll impact ASPs and gross margins. And I think everyone's expecting those to be, maybe slightly up. But I think the big question comes into the holiday with, again, some of this concern over consumer confidence. So where Apple guides for the December quarter, I think will be top of mind for pretty much everybody.
Well, and Ben, the sort of leaks, the indications that we've gotten, they haven't seemed great, right? Some of the indications out of China, some of the reports, some of the kind of tea leaves, if you will, on demand. I don't know. What's your read here?
I think there's a couple challenges. I mean, they are up against some compliance supply constraints, particularly as they're moving to a new process technology for the high-end iPhone. So TSMC's 3 nanometer process. There's constraints there. So what we don't know is how many they're making. What we do know is there's a sense that there's still at least some elongated demand in those product categories. Now, again, whether that eases in the next 2 to 3 months leading into December, we'll see. But there is enough signs that there's been some constraint. But again, what we don't know is how many devices that Apple's made and whether that's a significant enough number that these constraints equal a big positive versus just sort of a flattish year over year. That's why I think, again, looking at ASPs and gross margins will be very telling about if that upgrade base or new buyer base is skewing toward the higher end, which is what I think has been the trend over the last couple of years.
And Ben, I'm interested in your take on what is the long-term position and opportunity for Apple in China? Obviously it's a key link in the company's supply chain. It's a key end market, but you see Huawei making moves with its new smartphone. That's new competition. You see, obviously, Chinese authorities cracking down on Foxconn with this new investigation. Obviously, also just growing geopolitical tension between Beijing and Washington. How do you sort of think about Apple's long-term prospects there?
Yeah, no, and I think it's a good observation because you're right. I think competition is increasing again in that category. You mentioned Huawei, who again I think is starting to reestablish itself in that market. Xiaomi remains to be really strong with a lot of technologies. Foldables are actually starting to take some share there and become more attractive to a younger demographic and a more kind of early adopter demographic. So there is a lot more competition there. I do think that that's a concern point that many people are watching on because, again, that's one of Apple's largest markets. So iPhone sales there, iPad, they're seeing growth in Apple Watch, and obviously the Mac as a continued opportunity there is a continued growth opportunity. But I think it's important to know, right, they are facing more competition than they've had in the last few years. And so I think that'll be really telling again to see what China looked like as a market in terms of revenue, and then also kind of what we get in terms of a guide going forward. But I'm sure, as you know, the strong market for Apple is around Chinese New Year. So it would be somewhere around, first calendar quarter where we'll really get a sense of the strength of how some of these products are doing in the Chinese market.
All right, mark your calendars. Thursday after the close, Apple reports. Ben Beharin, thanks so much for joining us today, Ben. That was great.
Thanks for having me. Anytime.
And coming up, closing bell on Wall Street, we're checking in on the latest market moves and top trending tickers. Stay tuned.
was the closing bell on Wall Street. US Treasury lacrosse. It looks like Paul Rabel there, really giving it to the gavel. Let's do a quick check of the markets here as we wrap things up. We've got the Dow trading higher by about 124 points. That's good for a gain of 0.4%. The S&P 500 up 0.2%. Nasdaq up about 0.5% here to end this session. And what we've been looking at today is, kind of a rally, yes, not anything that is really too out of control. Part of that, seeing a little bit of a reaction to what we had in yesterday's session as well. A little bit of a give back from that, just like as well. Yesterday was a little bit of a give back from last week. But looking at the sectors, I'm just going to call up the Wi-Fi Interactive here and get on over to those sectors here as we wrap up this month on this Halloween. All of the sectors ending in the green on the day. Jared Blickry talking to us earlier about the month, but here ending on an up note. Real estate really rounding it out, gaining on the day by about 2%. Financials and utilities gaining as well, and that is in contrast here. Again, if you look at the month, we've had energy as the worst performer. Looking for real estate here, it was down 2.8%, so bouncing back on the last day here. And then looking at the Nasdaq 100 on the day as well, pretty mixed. A lot of green here on the screen, but none of the really runaway gains that we've been seeing in recent days. Smaller moves overall that we've been seeing in recent days. Amgen bringing up the rear here. It was down 2.9% on the day. That's after that company reported earnings. I'm going to take a very quick look at the trending tickers here before I leave you and before we dig into some more tickers in a little bit more detail. Pinterest, which we broke yesterday after the close, it was out with its numbers up 19% was all was said and done today. Caterpillar down 7%. As we talked about, the order backlog was what investors were focusing on. And Pfizer, interesting here, initially seeing some disappointment as a result of its numbers today, but now seeing it close unchanged. Immune Time Advanced Micro Devices, whose numbers we should be getting in the next, call it 10-15 minutes. Those shares finishing higher by 2.4% on the day, after rising 52% year to date.
Nice move. Let's get to some other tickers here. Let's start with JetBlue facing turbulence as it slashes its full-year guidance. The airline saying the sheer magnitude of air traffic control and weather-related delays has been staggering. So rough day for JetBlue here, Jules. In fact, rough year. I mean, the stock is down more than 40% now. So the loss they reported, not good. That was worse than expected by the street. Also talked about the shortage of air traffic personnel. That is having an impact. Weather-related delays. Analysts saying domestic market capacity has outpaced demand, so that obviously could mean fares coming under pressure. Bottom line, it's hard to find a lot of good news in this print.
It's really interesting here because we have some of the same fundamentals affecting the whole airline industry. Strong demand by most accounts, although waning a little bit on the lower end. Fuel prices that have been a headwind fairly consistently, right? Capacity issues, trying to get that balance right. And then, of course, worker shortages. But some airlines, according to analysts, have just handled this situation better than others. And JetBlue is one of those that has sort of struggled with these dimensions, right? The company talking about continued issues with air traffic control causing some problems for it. That's something we've heard from the likes of Southwest and its computer system, right, consistently. And then in the background is JetBlue's quest to buy Spirit Airlines, which is under legal scrutiny, right? And there's some developments regarding that. Basically, there has been a trial going on and legal actions going on as regulators have still been examining that deal. And so that, too, seems to be weighing on not just JetBlue, but on Spirit shares as well. Spirit's down off by 12% in today's session. Another stock that we're watching today on the other end is Arista. The Arista Network shares jumping after third quarter results beat estimates, and the stock also got an upgrade from Morgan Stanley to overweight from equal weight. The firm saying that the company is the best way to play an AI build out within networking. Networking overall has been coming in pretty decent. We had Juniper Networks recently as well. And basically, cloud demand means networking demand. It seems to be the read-through.
Yeah, so the big one here was Morgan Stanley liked what they heard. They went to an overweight or a buy, and they say the results indicate continued strength in cloud. They took their price target to 220. By the way, 63% of analysts have a buy rating, so there's a lot of fans. I will say Oppenheimer, though, less excited. They stick with a perform rating, so equivalent of a hold there. They acknowledge solid results, but on the sidelines because of valuation, they say. No, listen, that stock has surged this year. It's up more than 60%.
Yeah, and up another 14% today. It was the best performer in the S&P 500.
Yep. And finally, let's check out shares of e.l.f. here. The beauty is sliding as recent Nielsen data is showing moderating sales growth for not only the cosmetics company, but also for the mass beauty category. So this one, it was a bad drop in today's trade. It does look like it's on this Nielsen data. You're showing moderating sales growth for the cosmetics company, broader category. e.l.f., by the way, reporting post-market today. I know the street was looking for Q2 adjusted EPS at 53 cents on net sales of 197. By the way, though, even with today's drop, this has been a huge move in this name. It's still up, close to 70% this year.
Makeup in general has held up really well, and the thinking has been that if consumers spending is slowing, people are still going to be spending on makeup. But consumer spending didn't slow down. So, but people also still spent on makeup. So that seemed to be what was going on here. It's interesting. On the drop today, Piper Sandler came out and said the drop was overblown and that they would buy on weakness. So we'll see what e.l.f.'s numbers show, and see if we see some of that Nielsen data being confirmed.
Yeah, and that love, by the way, from Piper is not unusual. The street, they love this name. I mean, you have nearly 80% of financial analysts who cover e.l.f. think you should own it.
I mean, what's funny is, the Jefferies analyst who crunched this Nielsen data said that e.l.f. sales were up 45% in the 4-week period ended October 21st. 45% sounds pretty good, but it was a slowdown from 50% a couple of weeks prior to that.
It got knocked around, but again, it was up so aggressively.
Yeah, true.
Moving on to a very different topic. Defense in Sam Bankman-Fried's fraud trial resting its case. SBF facing more tough questioning from the prosecution over his claims that others were to blame for FTX's collapse. And joining us now is Helen Braun, CoinDesk U.S. Markets reporter, who was in the courtroom. So first of all, just tell us what it was like in the courtroom. What did you make of his testimony? What was the reaction to his testimony?
Yeah, so Assistant U.S. Attorney Danielle Sassoon spent about 2 more hours on her cross-examination this morning. And, Sam Bankman-Fried continued to be caught in lies today. For example, he asked him about his, quote, cozy relationship with the Bahamian government, including Prime Minister Philip Davis. At first, he said that he wouldn't say it was a cozy relationship, but that, they met multiple times. But Sassoon then brought up that the Prime Minister and his wife sat courtside at a basketball game at the FTX arena in Miami, and that those seats belonged to FTX. And Sam had previously said that he didn't know how they got tickets to the game. She also pulled up a video of Sam with former U.S. President Bill Clinton and former UK Prime Minister Tony Blair in the Bahamas, which Sam claimed were there for the FTX conference, which was partly true, but she pointed out the fact that they had dinner together, and she showed proof. She showed the court a video of them. And she also pointed out that FTX offered special deals for Bahamians and more. So that was certainly one line of questioning in the beginning of cross-examination that didn't go very well for Bankman-Fried. But the more interesting questions were those about Alameda's $8 billion hole in its balance sheet, and if that wasn't something that concerned Bankman-Fried after he found out about it, because allegedly he didn't know anything about it. So he told Sassoon that he learned about the hole in September or October in 2022, and that when he asked Caroline Ellison about it, she allegedly told him to stop asking questions. So that was a little odd, and Sassoon kind of made a joke out of it, saying, so your testimony is that your supervisees told you to stop asking questions. So very amusing today. And, like I said in the beginning, it's become clear that Sassoon is trying to show the jury that he's lying, which, is why she's asking him questions about topics that she has proof for and that she can contradict his answers with. And specifically with her line of questioning regarding the missing $8 billion, she repeatedly asked if he didn't think this was a big deal, if he didn't ask who was responsible for this, or if anyone was fired because of this. So I think she just wanted to make the point that this isn't something that you overlook, no matter how big your company is, and that, at any other company, this would be considered a disaster and probably, immediately investigated.
And Helene, a lot of the stuff that has come up in court is stuff that he has said previously publicly to journalists or in other forums, right? That now, is he saying wasn't the case or he was misrepresented?
No, he's certainly saying, similar things to what he said in interviews before and, after the collapse of FTX. I was one of the people that as the trial went on said there's no harm in Sam testifying. But the more I see him on the stand, the more I think this was a horrible idea. He, of course, seemed very, very confident during the direct examination by his own lawyer, Mark Cohen. And that might have helped his case to some extent. But cross-examination really brought out the side of him that, we all knew existed and that I think the prosecution really wanted the jury to see. And it's how much of a liar he is. We've come to learn the defense strategy a little bit more during his testimony, which is that he's putting the blame on everybody else. He didn't know about any of this. He didn't direct anybody to do anything. It was all everybody else's fault, specifically Caroline Ellison, his, former girlfriend and former CEO of Alameda Research. But it's simply not working. The fact that he doesn't remember anything about what his colleagues had said to him when they discovered the $8 billion hole. And, there's always other people involved. And, he never knows who made the final call for, certain decisions. So it's just such an obvious tactic that, liars follow. And this jury isn't stupid. They've heard very compelling testimonies from his inner circle and former friends who all said the exact same thing. So it's very much clear that, something's not adding up here in his testimony.
And so, Helene, bottom line, you were in the courtroom listening. It doesn't sound like you think he helped himself much at all here, which, by the way, we talked to former federal prosecutors who were saying, they would not have advised him to take the stand.
Yeah, definitely. And it's been really bad. It's also been really interesting to see his attitude toward Danielle Sazsoon, which, I think he didn't expect her questioning to be this direct and for her to be this tough on him. He's been giving her very short answers like, yep, and not sure, which, I'm sure his lawyers told him to do. However, it's very obvious that he's trying to avoid answering her questions and is trying everything in his power to make her job a lot harder. For example, he sort of repeats her question, but, with a twist. Like he adds things like, in this context or on that day, and then he answers that question. So sometimes it works, and other times Sazsoon or the judge call him out for it and say, that wasn't the question. But in general, it really doesn't look good for him. And, not only did he lose sympathy points because of the way he's answering Danielle Sazsoon and, the sort of standoffish attitude that he's putting on, but he also seems more guilty than ever after his testimony because of, his lack of answering the questions directly and, putting the blame on others and, getting caught in lies too with, concrete evidence that's presented by the government. So none of what he said, makes a lot of sense to me. And he just dug his hole deeper and deeper with everything he said on the stand.
Helene Braun, thanks so much. Appreciate it.
Thanks.
And coming up, we're minutes away from AMD's third quarter earnings results. We'll bring you the numbers and in-depth analysis next.
2023 rocked the markets.
NVIDIA, the stock has been on a tear.
Silicon Valley Bank's collapse is the second largest bank failure in the U.S.
Inflation,
Mortgage rates.
the diabetes drug, Ozempic.
Now it's time to make bold decisions. Yahoo Finance Invest, the marquee event for investors seeking big ideas and bold decisions. Guided by the newsroom you trust. Don't miss it November 7th, exclusively on Yahoo Finance.
Advanced Micro Devices out with earnings and out with a forecast that's the reason why the shares are down in after-hours trading. The company says fourth quarter revenue is going to be $5.8 to $6.4 billion. The upper end of that is what analysts had been predicting, so leaves it room to miss estimates. This is after its third quarter numbers beat estimates, but people look to be really focusing on the forecast here. AMD says it's going to see lower sales in its gaming segment in the fourth quarter as well, and that adjusted gross margin next quarter will be 51.5%. Analysts on average had been looking for 52.1%. So it looks like the last quarter was relatively strong. As you saw there, the numbers beating estimates. Revenue at about $5.8 billion here. Gross margin there up at 47%. But the forecast is not what the street was looking for.
Yeah,
here,
remember
Josh.
this stock was on a strong run year today. I mean, heading into this print, it was up about 50%. Some comments also from the company's CFO here saying they execute well in the third quarter. Looking ahead, saying that in the fourth quarter, see strong growth in data centers, so server chips, continued momentum in client, partially offset by lower sales in the gaming segment. A few themes I think investors are going to be interested on the call for Lisa Su, the CEO. One, just more color about the PC segment, what she sees now and what she sees going ahead. I think some people, they looked at the Intel report and saw some bottoming and normalization there. I think also that market for server chips that is critical for AMD. What do they see in the quarters ahead there? That's a market, remember, where AMD is taken share, and of course you expect lots of attention on the company's new AI chip. That is AMD squarely taking on NVIDIA, the poster child of the AI boom. So investors want to know how popular they think that chip is going to prove and how quickly can AMD kind of win over customers. What is the pace and trajectory going to be like there?
Yeah, the company really emphasizing the strength in its data center segment here. Lisa Su, the CEO, as you mentioned, saying in the statement, our data center business is on a significant growth trajectory based on the strength of our EPYC CPU portfolio and the ramp of Instinct MI300 accelerator shipments. So that's the strong part. Although, if you look at the third quarter here, data segment revenue at $1.6 billion was flat year over year, because they had some declines, and EPYC did well, but some of their other products did not do well. It was up 21% sequentially, but the CFO, Jean Hu, saying in the fourth quarter, data center will be continued strength, as will client, and then as I mentioned, gaming will be a weak area there. And she says additional softening of demand in the embedded market. So it looks like investors are focusing on the negative rather than the positive, at least initially here as we get these numbers. Anything else stand out to you from this statement, Josh?
Yeah, I'm just looking through the segment. So data center segment flat year over year. It looks like gaming segment, that was also down. That was down about 8% year over year to 1.5 billion. Client segment 1.5 billion. That was different. That was up 42%. But it'll be interesting the commentary she gives in the call. Again, a lot of focus will be on that new AI chip for the bulls. That is a critical part of their thesis going forward.
Yeah, the bulls not seeing much material, it looks like, yet in this statement. They're going to have to look to the call, perhaps, for a little bit of a reversal in the shares. So we'll keep an eye on AMD to see how it does as people continue to digest the numbers. Meantime, the UAW has now reached tentative agreements with all of the big three automakers, Ford, GM, and Stellantis. UAW President Shawn Fain is already thinking about the next steps in the union's fight, including expanding union participation.
One of our biggest goals coming out of this historic contract victory is to organize like we've never organized before. When we return to the bargaining table in 2028, it won't just be with the big three, but with the big five or big six.
So obviously Fain has big ambitions here, but there also are maybe big ambitions for what this means more broadly for unions in the U.S. For perspective on that, we turn to Arthur Wheaton, Director of Labor Studies at Cornell University. Thanks so much for being with us. This is a question that we have consistently been asking here and exploring. Let's focus first on autos. Are we going to see a bump in union participation, and are we going to see an expansion to, I don't know, attempts at Tesla, for example, in the wake of this?
There's already a negotiating group for organizing Tesla already. So they are already getting set to do that. And you have to remember the main plant in Fremont, California, used to be a UAW plant. So it was, we're a General Motors and Toyota joint venture. So it's had unionization in that building. So they're going to try to fight and get more organizing again. But it's tough to organize an anti-union company.
What can they do to overcome that? I mean, are there any paths that you see for Tesla to potentially become unionized?
The biggest path they just accomplished, they've got a tentative agreement. Once that agreement gets ratified and it's confirmed, then a lot of the non-union auto companies will either have to pay more or face the possibility of having organizing drives in their plant. So Tesla used to claim that they paid more than the UAW wages, but this contract really raised the lower paid temps and newer hires raised their wages a lot. So it was massive increases. So they will be looking for that in other auto plants as well.
And Arthur, I'm interested in what you made of sort of Sean Fain's tactics here. You know, it was different. It was aggressive, Arthur, right? He calls out the companies. He hits the cable news shows. He wears the T-shirts that say "Eat the Rich," right? What did you make of his tactics? What did you make of his strategy? And do you think that those tactics, strategy, that style, Arthur, could be replicated by other union leaders? Or is it just distinctive to Sean Fain?
I think it can be replicated because a lot of what he did is looking back to the past. So he based it on the 1937 sit-down strikes in Flint. So that strategy's been used, and some of the things he's doing with the international and the global labor movement are what Walter Reuther did for the 50s, 60s, and early 70s as well. So they can be replicated, and it's not too different from what they did at the Teamsters and UPS for some of the same things. Even though they did not end up in a strike, they used a lot of the same tactics.
Could we potentially see an acceleration or re-acceleration, I should say, in union membership in the United States as a result of this?
I think you will see an acceleration in activity, but the labor law makes it difficult to win the organizing drives if a company tries to be anti-union, hiring consultants to try to block it. It's still a big leap, a big hurdle, but I think you will see a lot more activity in things to increase wages and benefits to avoid the organizing drive. And I do think that they will have some success in organizing new plants before this contract expires 4.5 years from now. It's easier to organize when you can say, look at all the big wins we just got. Look at, nobody thought we could do it, but with a union and solidarity, you have this opportunity. So I think it will help their organizing drive.
And do you think, Arthur, the way this was all politicized, President Biden obviously was right there, flew to Michigan, showing solidarity. Did that have a positive impact? Is it a negative impact? Or does the politics really, the politicization of it really not matter in your opinion?
I think it does matter. So I think having the sitting U.S. president of the United States join the picket line saying, I'm with the UAW, it gives credibility or at least additional credence to some folks saying, yeah, there is some legitimacy to what they're doing here. And it also makes a difference for the politics for the National Labor Relations Board and who gets appointed in those positions. The previous administration was very much anti-union, and the rulings made it more difficult for unions to win their arguments. Now the NLRB is a little bit more willing to hear things and make changes more beneficial for the unions.
The other big question, of course, Arthur, is whether this all can be duplicated in a different labor environment, in a less tight labor environment. Do you think that it can?
Having solidarity and going out on strike helps. It can make a difference, but you had a lot of factors that were lined up in favor of the labor market or for the union. So you had very low unemployment. You had a history of very high inflation where they haven't negotiated raises in over 4 years. So this is the first raise in 4 years. And everyone knows that their pocketbook has been stretched the last 4 years, and it was time to make it up. That may not be the case next year or the year after that. So you have to strike while the iron is hot, do what you can when you can. And there's very much a lot of public support for unions. It was 80% in favor for the UAW versus 20% for the automakers.
Arthur Wheaton, thank you so much for joining us today.
Thank you.
And coming up, real estate stocks hammered on Wall Street. What's behind that move? It's coming up next.
President Joe Biden presented his plan to regulate AI on Monday, unveiling an executive order that aims to monitor threats posed by artificial intelligence, protect consumer privacy, and create the best practices on AI's role in our justice system. Yahoo Finance's Akiko Fujita spoke with TruePic CEO Jeffrey McGregor about Biden's plans.
I want to live in a world where when I'm scrolling through my news feed or looking at social media or doing anything else online, I know if images are created by computers or if they're created by humans and whether I should trust them or not. And I think that's fundamentally important. And what the EO does is it starts to align incentive structures for big tech to adopt technologies that do create this kind of visibility for consumers around the origin of content, the history of content, and allows them to make decisions on whether they should trust that content that they're consuming. And I think that's critically important at this stage as AI continues to accelerate. It continues to create challenges in terms of trusting the information we're consuming. And we need the right incentive structures to be able to create adoption of the technologies that exist today.
So, Jeffrey, what would those incentives look like in this space of authenticating digital content? And how might we also see that show up as a consumer? I know putting watermarks on some of these images and content has been one of the suggestions from the White House.
Look, I think social media companies in particular have proven over the years that sometimes financial incentives don't always match the incentives for consumer safety and health. And in this case, I do think regulation plays a very important role in urging these companies to adopt technologies that do exist today that do help consumers make more informed decisions. And to your second question, the way that this manifests is a very simple icon that starts to appear on images and videos that we see online. It's called content credentials. And content credentials, when you tap on that icon or scroll over it with your mouse, you'll essentially see verified, cryptographically secured information on where that content originated from, what the history of that content is, and ultimately if it's been generated by computers or if it came from a camera and it's an authentic human creation.
And on that point, Jeff, TruePic is kind of at the heart of that technology, right? In terms of being able to authenticate the images that are out there. You recently had an announcement where you developed this chip with Qualcomm that will be implemented in all Qualcomm, all phones that use the Qualcomm chip. But I'm curious, when you think about the scale of the problem right now, I mean, how much of a dent can you make just based on your technology, knowing how much content is out there right now?
It's a great question, Akiko. It's an all-out race, right? AI is moving extremely quickly. And part of why we're so excited about that Qualcomm partnership that you mentioned is it really does drive scale to this idea of content transparency. The vast majority, 85% plus of digital images that are captured on smartphones. So if we're authenticating genuine, real content at the smartphone layer, we have the ability to drive tremendous scale in terms of labeling content that is indeed trustworthy. Now, as it pertains to generative AI, we fully anticipate that generative AI will happen at the edge and leverage the compute power on smartphones for cost savings purposes. And labeling Gen AI content, again, on chip with Qualcomm, is a massive step forward in being able to drive scale to consumers so they start seeing that icon as they're scrolling their media feeds and just ultimately consuming information online.
And Jeffrey, what does this mean for creators in this space? Obviously, being able to track original content or how AI is sourcing content from other creators, how does this add some transparency to that?
I think that's the right word. I think it's all about transparency. And AI, I believe, is a massively positive tool, both for society, but also for creators. And if creators have the ability to label content that comes from them and the changes that they've made and how they've used AI in creating any piece of creative work or art, all of that is very positive and helps enable creators from an ownership and attribution standpoint in a way that I think will behoove them long term.
Really quickly, Jeff, I know you've done some work with the UN in the past. There's been a lot of concern around the disinformation, misinformation that's coming out in this Israel-Hamas war with those images, which ones are doctored, what not. I'm curious, based on what you know, what you have seen, what that tells you about how significantly this tech is expanding. I mean, have you seen a lot of that coming out of the region?
Absolutely. And I think it shows that there's a failure in our ability to detect whether images are genuine and where they came from after the fact, which is why approaches like TruePic that take a preventative approach in marking content at their origin are really important on the global stage. And we ultimately believe image transparency has significant value when in humanitarian crises, in any non-permissive or non-presence environment where we want to be able to have citizen journalists be able to capture images with trust and then distribute that online so that we as a society, again, know what to believe and know how to form our own opinions.
Our thanks to TruePic CEO Jeffrey McGregor.
And we are watching WeWork. Shares are plunging in the after hours after the Wall Street Journal reported the company is planning to file for bankruptcy as early as next week. It is a stunning reversal for a company that was once worth a peak valuation of $47 billion. That in the private markets, of course, before it came public. And we don't have confirmation yet that indeed WeWork is filing for bankruptcy. But indeed, this has just been such a stunning story to watch, the sort of paragon of the, co-working boom,
the poster
if
child.
you will, the poster child.
Truly, yeah.
Yeah, definitely. Yeah. And now to see it look like it is headed for bankruptcy.
Yeah, I mean, this is a company that was, it's incredible. It was only a few years ago. It was once valued at nearly $50 billion. Right. That was only in 2019, right? And to your point, Julie, you're absolutely right. There was so much excitement about this company among VCs in Silicon Valley, on Wall Street. There was talk there was going to be this massive IPO, and it just began unraveling. Of course, the co-founder, Adam Neumann, got the boot. I believe that was 2019. They did ultimately then merge with a SPAC in 2021, but the story ends here.
You know, I'm surprised at how many properties the company still has. According to the Journal, as of June, it had 777 locations across 39 countries. That includes 229 in the U.S. But it also had about $10 billion in lease obligations. And why is this story so remarkable? You know, at its peak, Adam Neumann painted this as, you know, like so many companies, right? It wasn't just a co-working company. It was the we company. It was how we were going to do everything. We were going to live together. We were going to work together. This was sort of a new ethos for how corporate America was going to work, right? That there would be this sort of collegial atmosphere where people would be in the same space. It would be flexible. They would only need to be there when they had to be there. But at the end of the day, it's a real estate company. It's a subleasing company. And there's kind of no kind of magic pixie dust you could sprinkle on that changed that fundamental fact.
And to your point, just reading the Journal here, as of June, they still do maintain more than 700 locations, 39 countries, 229 locations in the U.S., by the way, and an estimated $10 billion in lease obligations due starting from the second half of this year through, it looks like, 2027.
Yeah, fascinating stuff.
Incredible. All right, moving on to another good story. Take a look at shares of Zillow here, closing down. We're looking at about 7% there on the day. The company and other real estate stocks sliding. That's after a Missouri jury found the National Association of Realtors and other industry players guilty of colluding to maintain high brokerage commissions, Julie. And this one, not just Zillow, by the way. Other names to look at here. It looks like it took down Compass and Redfin, among others. So a few different names got tagged here in the after hours.
Yeah, even though these are not companies that were named in the lawsuit. Right. This is a lawsuit, by the way, that Emily Peck of Axios came on recently to talk to us about. Basically what it is here, when you buy a piece of property, when you buy a home, you pay broker's fees if you are selling the home. And then basically the buyer and seller's broker splits the fees, but it's not a transparent system. At least that's what this lawsuit was alleging. And now it looks like this lawsuit has been successful. So that is what happens now. So what happens after this is kind of confusing. We don't know yet, in other words, what the effect of this decision will be. Now, the National Association of Realtors says bad stuff will happen, that it's going to be harder to buy a home. It's unclear if that is exactly what the effect is going to be, but the jury has awarded almost $1.8 billion in damages in the case. There's already another lawsuit also that's outstanding that's even bigger. So we'll see if that goes in the same direction.
Yeah, we should know the National Association of Realtors is apparently saying that the group does plan to appeal. They argue this is going to take years to resolve, as these things often do. So we do have this headline, but it looks like this could be a story that's long in the making here. And they also apparently are going to ask the court to reduce the damages awarded by the jury. So a big headline here, but it looks like this fight could go on for a while.
Yeah, and we'll start to get, I'm sure, some analyst commentary tomorrow about what effect this could have on many of these companies. You know, I'm not certain how much brokerage fees accounts for how much they make. So I guess we'll be digging into this more.
We shall see. All right, coming up, we're going to go around the horn with today's top stories, including spooky Halloween candy prices.
Wait, you didn't say that right.
I didn't have the music.
Spooky Halloween candy prices. Come on.
Well, that was scary. All right. I am spooked.
We'll be back.
Welcome back to Yahoo Finance Live. I'm Alexandra Cannell here with Josh Schaefer and Pras Subramanian. We've got a few stories today. Happy Halloween, everyone. We'll be talking that in just a bit. But Pras, I want to start with you with Tesla. Spooky stock with that shares hitting a 5-month low. They've since recovered today. But what's going on with this company?
Yeah, a little bit of a respite today. Look, it all started when they had earnings this month. Just a kind of a spooky or scary earnings call by Elon Musk talking about how rates were affecting the costs of financing cars and thus making their EVs more expensive, and it's going to be a problem for buyers. And that sort of began the downward slide in the past month. And just yesterday, you saw On Semiconductor making these carbide silicon chips that Tesla uses, warning about demand there. And then also, we saw Panasonic, which is one of the battery suppliers for Tesla, talking about how the batteries that it makes for its higher-end Model X and Model S cars, sort of not, the demand is not there, so they're sort of marking down some of that, I guess the demand, projections coming down. But then also today we saw, or 2 days we saw, yesterday we saw, Musk's other venture, X, right?
Yeah.
Getting its Fidelity, marking down its sort of value for its stake by 65%. That's not good, especially if you're an ex-employee and you got stock sort of options there for that company. So that's not good there. So a kind of a scary October here for Musk and potentially Tesla.
Really like a scary 3 months, right? When you just zoom out since Tesla's last earnings and sort of how the narrative has shifted around. I think how Musk is able to convince sort of his crowd of the bigger Elon pitch. That applies, I think, to both X and also Tesla. Tesla, as we know, is a stock that has been valued with AI in mind, right, at times, right? And thinking about full self-driving and sort of the future of tech. And I think that's what people thought when he bought Twitter too, and he bought it for a very expensive price. So Musk has always been one of those guys that's able to sort of pitch the big future. But right now, that's just not really where the market's at when you think about a company like Twitter or a company like Tesla. The big future isn't that easy to see when a lot of things are pressing down on tech companies and pressing down on valuations. And I think Elon's sort of just getting caught up in that here a little bit. Maybe Joe Rogan can change some market sentiment with his big podcast today on the Rogan podcast.
Yeah, and to me, when I think of the EV boom that we've seen, we've heard from a lot of automakers warning that the demand has just really gone down pretty significantly. And if you're a company like Tesla, all they do is EVs. Do you need to diversify? Are there other things that Tesla needs to lean on if the demand continues to wane for EVs? I think over the long term, it will tick back up again, but pricing, consistently a big issue. Infrastructure, it feels like we're a little bit ahead of the times right now when it comes to full EV adoption. And what is that going to mean for a company like Tesla and the share price of Tesla down the line? I think is a huge question mark.
Yeah, I mean, Musk would argue that, just taking a side of this, with that Cybertruck is coming next month. That's going to be supposedly I think you like talking about levers to pull, right?
Yeah.
Cybertruck's there. That's one big thing that's going to happen.
You have to actually deliver. You have to actually deliver the trucks, but
yeah, that delivered. But plus, we're seeing that demand is for at least Tesla is not going away. It's more of a question about how do we afford these cars and SUVs, and that's where he's really hammering that high rates sort of discussion. Why do we have this? We don't need this. It's bad for any kind of discretionary purchase. So that's where we're sort of at with this. But yeah, I think big picture, it is a sort of like speed bump in the road. EVs are happening. It's a question of can we get them cheaper, and then also like a better sort of feature set.
The high rate argument is an interesting one too, because I get what he's saying, but is he going to drive rates down quicker? Like those rates aren't coming down realistically for probably at least a year, right? When you talk about actually meaningfully coming down, it's just like when you think about what that actually means for Tesla, sometimes I get lost in the Elon argument.
And we're not even in a recession yet. So what happens if the economic situation deteriorates right now and you're already in
But the Cybertruck can't get hit by arrows.
Yeah, I was going to bring that up. Joe Rogan tested it. There he is.
Yeah. That's really the takeaway here.
Yeah. Well, Tesla is a company that continues to innovate, and I want to move on to a story that's really focused on innovation and really the next thing when it comes to live entertainment, consuming live entertainment. Now, this is a collaboration with Warner Brothers Discovery and this privately held company called Cosm that works with a lot of immersive technology, and they're working together to broadcast both NBA and NHL games in shared reality domes. So what does this exactly mean? So two venues are going to open up in 2024, and that's going to allow sports watchers to really tune into these live games. You're seeing some of the images on your screen right now in domes with 8K screens. So you'll have some of those select games available. I mean, look at that, 87 foot domes. I mean, this is pretty crazy. If you really want to get the full experience of watching something, obviously this is sort of capitalizing on a lot of the trends that we're seeing in this market right now, like the Las Vegas fear, for example, has drummed up a lot of optimism about this type of innovation. But to me, I feel like this stuff is it's a trend, in my view.
No, it's Field of Dreams. Build it and they will come. You don't know that you want this until you have it.
I know, but I think of
and
stuff.
you're surrounded
I think of
by
the
football.
metaverse, right? There was so much money being poured into the metaverse. That was on every company was talking about the metaverse. What happened to the metaverse? We had companies like Meta pouring a lot of money into virtual reality, mixed reality, even Apple with their headset. I don't know anyone that really has invested in the Apple headset. I don't know anyone that's really talking about the metaverse anymore. And you wonder if this is just a fad.
To me, the pushback to that would be this is built around content that we already know that people want. The Meta headset was built around new content that was also being tested, right? Not necessarily video games we had previously played. They weren't totally putting, say, Call of Duty, a popular video game franchise, in the Meta headset and saying, here's a more immersive experience for something we want. We talk about sports streaming all the time and sports broadcasting. It's the most popular thing on television. So that to me is one of the positives of this is you're taking something that there's demand for. People like watching sports. People actually like watching sports with friends in interactive experiences, right? So to take that and push it a step further, I think is what gives it a little bit more opportunity or maybe runway to build. Then I get the metaverse comparison. It's totally fair. We're building something that who asked for this? But I could see that playing out well because I want to go watch football at an 87.
I feel like I get dizzy.
I think it might actually. I think you might maybe appreciate it as like an IMAX thing, right? It's like people want to see IMAX. Maybe they want to see sports in that big, large format, kind of immersive environment. It's not necessarily augmented reality or even virtual reality. But I want to ask me. I spoke to Rory McIlroy a couple weeks ago about TGL, which is Topgolf Live, and that sort of has this mixed reality sort of environment where you have like this screen that wraps around the whole sort of stadium, but people sit kind of up top and the players play in this virtual sort of golf-like sort of simulator. And I think we'll see if that actually has any kind of popularity, but maybe people are into these live/video/ 8K HDR. That's lots of big words there. I think it's going to be like maybe another future of sort of participatory sports.
Yeah, and I mean, we know, like you said, we know the demand is there. We know people love live sports, even concerts, Funflation. Everyone's going out there and wanting to see
NBA,
a concert and experience. So maybe.
And it gets at the last point I'll make on it is something we've talked about with how much these sports rights cost. And you see Warner Brothers Discovery wanting to find another lever to pull to get revenue, right? And you're going to want to do that if you're ESPN with whoever that buyer ends up being, whoever that investor is. Get more money when you're paying billions of dollars because you want more money, guys, because here's your transition. It's Halloween.
Yay!
And that candy is getting more expensive. New report out today showing Americans are going to spend the most they've ever spent on Halloween candy, over $2 billion expected to be spent on Halloween candy. That's, of course, as inflation has sent a lot of these prices higher. Guys, a lot of takeaways to think of when you think about Halloween as a whole, and you're looking at right there, you can see candy and chewing gum up over 20%. That's more than food at home has been, of course, a lot more than all items have been. Yeah. But, I mean, favorite candy. I think that's where we gotta go.
Trick or treat.
Trick or treat?
What do you want kind of candy you like, Allie?
Oh, I like Twix.
Reese's. I'm a Reese's guy.
Reese's or Reese's?
You can't really see it, but I have cat ears on.
Reese's.
Reese's, okay, yeah, Reese's is a very popular choice. I like Twix. Justice for Twix, there was a survey. It was pretty low on the list that I was very surprised about.
Kit Kats, Twix, Snickers. Where does Snickers at? Butterfinger's great, stuck in the teeth though.
No Butterfingers. But you know, with pricing, I also thought of shrinkflation. I'd be very upset if I was.
Is this a Halloween costume, by the way?
You guys are cowboys.
Like, is that a Halloween costume?
No, it's Yellowstone, man. Yellowstone. We're Yellowstone. Yeah.
There we go. And you were saying a lot of streaming shows.
I'm the one guy.
The other chart that we have today that was one of my personal favorites because I hate candy corn.
I'm Rip.
Candy corn declining. Overall demand.
That
lot less
doesn't
people
surprise
liking
me.
candy
Terrible
corn.
candy.
Hey, listen, as it gets expensive, like that's something I'm just not buying. Cut it out.
Ooh,
right?
gummy though. Gummy's rising. Marshmallows.
All right, this is making me hungry. We got to go get some candy. We'll go trick or treating.
Yeah.
We'll find out. You'll have more Yahoo Finance Live on the other side.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there is more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
It's closing time here at Yahoo Finance. Here's a look at some of the top stories of the day. Match Group shares sinking after hours. The company's fourth quarter guidance missing estimates. And just ahead of the results, the company's settling a lawsuit with Alphabet. President Biden, meanwhile, will be meeting with Chinese President Xi Jinping next month. The White House making the announcement earlier today, and the meeting will take place on the sidelines of the Asia-Pacific Economic Cooperation APEC Summit in San Francisco. The White House saying it will be a tough conversation with Xi. And finally, the Treasury Department announcing the rate for the new series I-bond at 5.27%, which is the fourth highest rate since I-bonds were introduced in 1998. The nearly risk-free asset will pay 5.27% through April of next year, and that's up from 4.3% rate offered since May.
Time now for What to Watch on Wednesday. Fed Chair Jerome Powell will take to the podium once again with the central bank's latest rate decision. The press conference set to begin at 2:30 p.m. Eastern Time. Expectations are widely set for the Fed to extend a recent pause on interest rates. Investors will be looking for any hints if another rate hike is on the table. And moving on to the labor front, ADP is going to release its national employment report. The latest numbers will reveal the change in U.S. private employment in October. This coming after September showed the slowest pace of growth since January 2021. And lastly, investors can expect another jam-packed day of earnings. In the morning, Norwegian Cruise Line, CVS, Kraft Heinz, Yum Brands. They're among the names set to report their latest quarterly results. And after the market close, expect to hear from names like Qualcomm, PayPal, Roku, and Airbnb. I'm getting tired just listing those. We will be here tomorrow at 2 p.m., not 3 p.m., 2 p.m., to bring you that latest Fed decision as well as the press conference, preview of it, reaction to it. Join us tomorrow. We'll be talking all about it and then those earnings after the close as well.